Hi, Steve Sosnick here with today's Interactive Brokers Morning Market Morsel. We got a bit of a head fake today. The futures opened stronger based on the bounce in China, which was attributed to central bank buying, or at least the government stepping in to prop up the markets, however you want to put it. But that enthusiasm faded very quickly, and we saw the market sell off. Not to worrisome lows, but definitely giving back its gains and then some very quickly. Makes me wonder whether the paradigm has shifted towards selling the rallies as opposed to strictly buying the dips. Remember, buying the dips has worked very well, but you had a huge tailwind. You've had a Fed that was basically pumping money into the markets, along with global central banks. That's not the case now. The U.S. is not nearly as accommodative. Other central banks in the world, well, the ECB hasn't yet turned restrictive, but they're certainly there's an end to their accommodation in sight. You're just not seeing the same backdrop. I think the U.S. was able to ignore the beginning of the Fed tightening cycle because the corporate tax rate was helpful. What we saw was first there was the talk about it, which provided some lift to the marketplace. Then it occurred, and we saw a lot of that money being used to buy back shares and also to make year-over-year earning comparisons look very good on an after-tax basis. All that was positive. The economy's been good too. But remember, the markets really rely on money. And if the source of their main ingredient, which is the money, is harder to come by, it's going to be a little tougher for the market to bounce sharply and for buying the dips blindly to work well as it has in the past. Think about it this way. At this point, the major indices in the U.S., let's see, the S&P, is up just under 3%, 2 and change. Well, I can invest in a 3-year T-bill for roughly 2.3, 2.4%. So am I really getting compensated for the extra risk that I'm taking in the stock market? The valuation is not as compelling as it was when you had basically the yield on the S&P 500 far outstripping the yield on medium to longer term corporate debt, government debt even. That's not the case anymore. And so I think to a certain extent also a lot of these buybacks have been debt fueled. So I think it requires a bit more caution, a bit more hedging. Keep a very close eye on the 200-day moving averages. They've provided support on the way up, and we'll see if that support holds. If not, I think it won't be a one-day event. It would be a process. But I think if the market gets convinced that we're consolidating but not really rallying, you could see a bigger change in sentiment. A lot has to do with the election coming up, midterm elections. There's so many variables. Be nimble, control your risk, keep an eye on those 200-day moving averages. Thanks.